Hello everyone and welcome to Jim Dalton's presentation for an intraday trading real-time session, and for our European and overseas traders for a little better time for you all. It is 11:30 a.m. Eastern, and we will go until about 12:30 p.m. Eastern. And Jim and I want to thank everyone for being here and taking time out. It's great to see you all. And questions are encouraged. This is being recorded, and we will have it at our site in about an hour after we complete the session. Okay, so thank you everyone. Enjoy the presentation, and I will introduce Mr. Jim Dalton.
Good morning. Thank you for being here. We'll just do a couple of slides and we'll be into the real market very, very quickly. The market profile accommodates the transition from on-floor to off-floor trading. Historically, when so much of the short-term trading was centered on the floors, the advantage that the floor traders had was sound. When they would hear if the market went up to yesterday's high, for example, and the volume level came up, they had a pretty good idea that there was a new flow of orders coming into the market, and they would go with that. If you came up to yesterday's high and the sound got very quiet, they instinctively turned their palms down. When it was on the floor, if the palms were facing your face and you had your hands in the air, that meant buy. If you rotated the palms out, that meant sell. So if the market went up to yesterday's high and the noise level was very high, the palms were facing the trader because he was buying. If the sound got very low, those palms went towards the crowd or away from his face, which is an indication of selling. It was kind of an instinctive reaction. They traded an awful lot by sound. The sound told them if new orders were coming in or if new orders were drying up. A very small percentage of the traders that attempted to make the transition from on-floor to off-floor trading were successful. Part of that reason was that the world changed for them. They lost the advantage of sound. But what happened to folks like myself, we got an advantage because around the same time came the market profile. And the market profile gives you an edge from electronic trading because it allows you to see the market. So the edge that the floor trader had was sound. The edge that we have from upstairs now is visual because we can see the structure of the market as represented via the market profile. And we're going to go into that very, very quickly. First, the next slide, and then we'll go back and we'll go to the markets. This was yesterday's profile. On the upside, there was an anomaly starting right here at 1986. An anomaly is something, and the reason I call this anomaly, it's less wide. I mean, it's one tick wider than it is at the next higher price. Then we have anomalies here, 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 and here. And what happens, that anomaly, it just shows you that the market's not proceeding smoothly through time. The more symmetry you have to a profile, the more indication you have that the auction is proceeding smoothly. Yesterday, what did I do? I'm sorry, I'll be right back there in a second. I must have hit the wrong key. Okay, so you look at those anomalies, and it tells you that the auction's not proceeding smoothly on the upside. And what was going on yesterday is we had a market that got far too short in the morning, and then the short covering took place the remainder of the day. Short covering can actually weaken a market because it's removing potential buying power from that market. Very often we will see these anomalies revisited. And what you will see, if you look to the right, you will see that this morning's market early on revisited overnight trade, and the early trade revisited all the anomalies from yesterday. That is not uncommon. Before we go to the live markets, I made the comment earlier that the market got too short in the morning. I believe that Julia sent out the report that we did last night. It's called the Recap and Preparation Report. It somewhat recaps what happened the previous day, and it talks about potential for the following day.
Jim?
Yes.
Pardon me. I didn't send it out to people. It's posted at our website under webinars, upcoming webinars, and in this post for this particular webinar, you'll see a download link there to read that report as a supplement. Pardon me. Thank you.
Okay. Thank you. What the recap report shows is that yesterday morning's early rally went to a single tick above unchanged from Tuesday. What we've talked about so often is that the unchanged level is a very important reference for daytime frame traders.
Which also means close or settle of the prior pit session. Pardon me, Jim. Just to...
Correct. So when the market went a single tick above unchanged and then began to sell off, that told me that the traders that were selling the market were daytime frame traders or short-term traders. Short-term traders being maybe up to 3 to 5, maybe 9 days. But it wasn't, and this is important, it wasn't longer-term money, intermediate or longer-term money that really has a more serious contextual change in markets. The next indication the market was getting too short.
Jim?
Yes.
Excuse me, can you show your profiles just for a visual aid if you're talking about the Tuesday session or the Wednesday session? Can we look at the window trader blue?
Okay.
And maybe split it out. I don't know, for people not familiar with looking at composite profiles. Excuse me. Thank you.
Okay. This is unchanged. The circle right here is unchanged from Tuesday. The early morning high yesterday was a single tick above unchanged from Tuesday. The market then proceeded to trade lower.
Jim, I'm so sorry.
Yes.
I promise this is the last one. For people watching, the x-axis of the dates are 1 day off, and Jim and I will fix this, but 9/9 is actually 9/10. I know that we're a lot of fun, but that just ignore that. This is yesterday's pit session, and we are currently watching trade in today's pit session. So we're referring to Wednesday, September 10th, 9:30 a.m. New York time to 4:15 New York time. That's it. Thank you, Jim.
The circle right here is from Tuesday. The circle is unchanged, or the settle, from Tuesday. Wednesday's high was a single tick above that. The market then sold off. When that sold off, that told me that the sellers were more than likely daytime frame or short-term traders, meaning daytime frame, come in long or come in flat, go home flat. Short-term traders, 3 to 5 days, maybe slightly longer, versus more serious selling being the intermediate or longer time frames. And that's very important. When we talk about helping our clients understand trading, we try and understand trading not from the numbers, but from the behavior of those people that we are competing against. When I know that this is more than likely daytime frame and short-term traders, I know that they are more fickle. I know that they're not like the longer-term traders where they put on positions for extended periods of time. The short-term, the day and short-term traders are very opportunistic. They may trade very quickly based on whether it's the dollar index or something that they have in their mind. But they will change on a dime, which makes markets very volatile. When it's mostly day and short-term traders, you have a tendency to get multiple inventory corrections throughout the day. So what happened yesterday when they're selling right here, it tells me it's weaker hand selling. I know they're more fickle. the early rally, we put a low in A period. Then the market rallied in B period. The rally in B period was to a single tick above half back. One half back, one half of the initial range from this period is another day time frame reference. And that day time frame reference, again, when it traded a single tick above half back, and it won't show here because half back changed as the day went on. But a single tick above half back and then sold off again, that told me that what happened, the short-term sellers, day and short-term sellers sold early. The market went down on the first bounce. They sold it again, and they sold it at a very mechanical reference, one tick above half back. That helps me understand the behavior of those traders that I am competing against. And I know that their tendency is to get the market either too long or too short. And as you will see, they got it too short early in the morning, and then we had a short covering rally throughout the remainder of the day. Now, one of the things that coming up here in around the end of the month, we are starting a 30-day intensive. During the 30-day intensive, and the reason for the 30 days is to give you more of an opportunity to understand many of these nuances that we are talking about. So during the intensive, we do about 8 hours a week of seminars like we're doing right now. But when I'm not live, we have a chat room. It's a one-way chat room, but it allows me to put chats out to call your attention to things. So who knows what I would have done yesterday, but more than likely I would have chatted that the high was a single tick above unchanged from Tuesday. I more than likely would have chatted or posted that we were a single tick above unchanged. And that's the kind of thing that helps you get in touch with the markets. As you can see, then the rest of the day was mostly short covering. Now, let's collapse all of this. I just hit the wrong button. Sorry about that. But let's collapse all of this and come over to today's profile. What
if you you can right-click on the profiles that are split and put them back together. Right-click and just say session.
Well, I don't have to.
Session. Well, it looks kind of weird for splitting today's the final one down at the bottom on the left.
Okay.
And you might have to.
Let's not worry about it right now. Okay. The other references that we think are, and we wrote about it again this morning because we put out a morning report. We put out a report in the evening that says recap preparation for the following day. Then we update that report in the morning. The last thing I believe I said this morning was to remember that the overnight high and low are always significant day time frame references. So right here's the overnight high at 1995. Here's the overnight low at 1985 and 1985 even. You will notice that all of our trading so far today has been contained within the overnight range. So again, when I see this, it tells me that there's really no change today relative to what we saw yesterday. I don't have any indication in here that I have anything other than day time frame and short-term traders in the market, taking the market too low, then taking the market too high, and all this is just inventory and rotation going back and forth. That is extremely important information to have at my fingertips, because if I don't understand that, then I can get too excited and think, wow, do I have something really serious going on in this market? Or do I more than likely have a rotational day? And more than likely I have a rotational day. The high isn't very impressive, so we may get something later on, but that is how you get yourself oriented to the market and keep yourself from getting too enthusiastic about anything that's going on in a marketplace. Now I want to show you one more thing. Earlier on, we talked about anomalies from yesterday. You can see this profile split out. Forget about the D period on the far right. Early on, we had A, B, C right here. With A, B, C, then the market went down and made a new low, which was one tick short of the overnight low. The anomaly here at A, B, C stuck out like a sore thumb. So what happened down as this went down, we had A, B, C, and then underneath that we had AC, AC, AC. So when we're down here, we're 2 wide down here, we're 3 wide up here. And then as soon as this market was struggling, the tempo was very slow in its attempt to take out the overnight high. When you're looking at that and the market can't get through the overnight low, plus you've got an anomaly up here, it's 3 wide up here, it's 2 wide down here, that visual look tells me that the wider the price is at any one point, that is what we consider the point of control, or more importantly, the fairest price at which business is being conducted. So what this told me was when I couldn't get the low out, that markets were probably getting too short in the hole. People were selling short below the fairest price of the day, which was the anomaly at ABC, which said, okay, the market is getting short in the hole. And once you can't take out the overnight low, guess what? Now the market's going to rally, and once it begins that rally, the objective becomes the opposite extreme of the overnight range, which is the overnight high, which is just the market fell short of the overnight high. But we very often make trading far more difficult than it has to be. There are guidelines, very sensible guidelines. Once you understand the behavior of the people you are competing against, that will help you have a much clearer perspective of what is going on in the market at any current point in time. So right now, we are developing we have an inside day developing. The market is coming into more and more balance. Okay, let's stop here, Julia, and let's take some questions based upon what we have talked about so far.
Yes, thank you, Jim. Tuesday's session, people are asking, we have a couple of people that appear to be long liquidation from the open. And I'm curious if you are interested to go over Tuesday's session. If you could do me a favor, Jim, and just hold down your shift key, and from when you're on one profile there, you want to grab the whole profile while you're holding your shift key down and control no, not left click, right click. Hold down.
Okay, shift
you want to
key down
hold your shift key down when you're
okay.
First put your cursor, let's do it over Wednesday's session. Put your cursor to the left of A, okay, to the left of the A period. You want to grab the whole profile with the shift key down. So hold your shift key down and now scroll your left. Yeah, there you go. Now click enter. No, all the way across. Once you have it highlighted, click enter. Hit enter.
Okay, it didn't do anything.
All right, then let's just right-click your profile. Go to Market Profile.
Joe, the only way I know how to get these back together is to close it out and restart.
Do you want to do that?
If you want me to, okay.
Well, it's going to be difficult to look at Tuesday like that. So we have a question, and while that's restarting,
While that's coming up, there will be questions about, this is the roll day. On the day of the roll, I use the old contract. The day following the roll, I will switch to the December contract. And it's just it's an awkward setting, but that's what I need to do it gives me the best perspective over time. Okay. Now we're going back to look at Tuesday.
Yes. So we need to see Monday as well, or at least scroll down a little. So, and I believe on this day we had the overnight inventory short as well.
Overnight inventory was short. Okay. All we had was we had an inside day from the previous day. I'm going to split this out from A period.
Yeah, no, cancel that, Jim. Cancel that. And just right-click, cancel it first, please. And then right-click on the profile, market profile, expand profile.
Okay. I had what I wanted the first time. Okay.
Oh, sorry.
This was the market opened, traded off immediately, left a poor low. A poor low means it's not a secure low. Rallied, and then you got another break, another rally, and another break. I mean, a very, very difficult day going on. Almost an impossible day to trade unless you really were in tune with the market. And what really was helpful on this late rally was a shortcut. The market got too short. Not only, we had several things going on Tuesday. Not only did we have the market too short in the morning, and then you got the short covering rally. But the short covering rally was just crazy. And once it looked up above the early morning high and failed, there's your potential short for the afternoon. And remember, we were talking about anomalies. When you look at the rally and I period, at that point in time, we were 1, 2, 3, 4, 5, 6, 7, 8, 9 wide here in I period. The market rallies in I period, leaving this 9 wide. When the market is that wide, the odds are very good that price is going to get pulled back down to that level unless the rally was on substantial volume. You need substantial volume to get away from the fairest price and be able to stay away from it. The fatness down here, or this is where the fairest price of the day was at the time, unless you get heavy volume, the chances are you're going to get pulled back down. So you get the short covering rally that failed. You looked 3 ticks above the morning high. Once you came back into the early morning range, your short was underway. The market then broke all the way down, and again, the same thing. When it was 9 wide here, now with J period, it's 10 wide here. 11 wide when you consider K period. So when I period breaks down here, it's exactly the same thing that we had from the high. So you got pulled back towards the center. And as you can see, the market went back towards the center and it opened, I forget where it opened the following morning. But anyhow, that's what was going on. So all you had some early liquidation. You had nothing but short-term traders. They got too short early on, then they got too long, then they got too short, and they had to cover again. That's the craziness of how these market trades. But there are ways for you to bring the odds in your favor. As we said early on, once you learn to read and interpret the profile, and it's not easy, you will have a much better chance to understand what is going on in the marketplace and give you a better opportunity to trade it intelligently, or more importantly, to stay out of trades that you don't want anything to do with. Okay, so that's kind of what happened on Tuesday. Other questions?
Yes, thank you, Jim. How do you trade around the start of a spike when the price trades above and below the base of a spike? You know, I guess on Tuesday that would be one spike that he may be referring to.
Okay. We always say that the base of the spike, if it's below the spike, the base of the spike is support. So the base of the
resistance.
Spike is resistance. So there's the base of the spike. If you'll notice, early in the morning, there was no acceptance above the base of the spike. It traded above the spike and a tick above unchanged, but it never got one right in here. But that was your resistance. So it failed at the resistance. It then traded lower. Notice once it came back through the spike, later to the resistance later in the day, then the market auctioned higher. So the base of the spike served as a reference for me early in the morning, as well as a reference later in the afternoon. So, you know, nothing is there's nothing that is an absolute rule. All of the things that we point out as references, they're guidelines. They're guidelines to use. Worked very well to keep you oriented in the morning, and it worked very well to help you stay oriented in the afternoon. So again, it's a reference, and you learn how to use that reference intelligently. Okay, additional questions?
Yes, thank you.
That was a good question. Thank you very much. As you can see, you know, it served multiple purposes on Wednesday.
Right. No, that's great. Thank you, Anthony. How does Jim determine that a market gets too long or too short in the day? What does Jim look for and take note of? And Jim, before you answer that, just, you know, Jeff, it's a process. It doesn't just happen. It usually we're carrying the overnight inventory forward, even the prior pit session, the spike on Tuesday, we saw it push lower late in the day. So it's a process. It's not a static observation, snap judgment. But go ahead, Jim. I just wanted to mention that.
Well, I mean, I basically I've already covered that. You know, the example was the other day when I said it looked a single tick above unchanged from the previous day. That tells me who was selling, and then I said the rally went to a single tick above half back. So that gives me a pretty good idea that it's weaker traders in here. If those weaker traders are racing to the bottom and getting the market too short, some of it's, you know, trading is an art, not a science. Anybody that tells you it's a science, I believe, is incorrect. If it was a science, it would all be programmed, and there'd be no advantages for any of it. So it's understanding who's doing the trading. So, you know, when you understand that they sold off from those two references twice, there's a pretty good idea that it's getting too short, and anything can trigger a recovery. Just as this morning, as I said this morning, we went through the example. We were 3 wide up here at the fairest price. When the market went down and couldn't take out the overnight low, how do you get down to that? You sell. So you had people selling the market when they couldn't get out of that. Then you've got to understand that they're too short at that point in time. Then the next thing is likely to have a short covering rally. Nobody is going to ring the bell when you're too long or too short. It's something you develop over time. You develop over time. You get in touch with the market. And that's, again, that's the purpose behind the intensive, so we can walk through these things over an extended period of time, so you start to be able to develop a feel for it. And a lot of times, if it's a rotational day when the market gets too short, which it was this morning because we didn't know it was going to be rotational just then, but the fact we don't get outside of the previous day's of the overnight low, got a pretty good idea that, you know, it's rotational. and we've pretty good idea that's not joined by any longer-term selling, or we would have easily taken out that level. Once you get that feel, you say, okay, and you were 3 wide up here. What were traders doing? They were shorting in the hole, or they were getting short below the fairest price for the day. Does that always work? No, but it does tell you to be very careful, because if they don't get downside follow-through, they're going to be forced to start short covering very quickly. Okay. Now, going back to the current market, we're still within the overnight range. We're still within yesterday's range, so we have a very balanced situation today. Now, we talk about market understanding, self-understanding, and market logic. We a lot of times don't address market logic too often because we're staying, with things that are more visual. But let me talk about what I think is going on in the logic of the market right now. Last Friday's employment report caught the world off guard quite a bit. And they really didn't know it wasn't what they were expected. And everybody said, oh, it's just an anomaly. It's just an anomaly. What I wrote in the report over the weekend, that I thought that the market would that probably confused an awful lot of the participants in the market. And I said I thought one of the things was that this was a slow week for economic releases. So they weren't going to get much pertinent information until Friday, tomorrow. And what I wrote over the weekend was I thought that the sales report, the retail sales report, which comes out tomorrow morning, would probably be the most important piece of information for the market this week. And the reason being, if the retail sales report is solid tomorrow, then I believe from a market understanding or logic of the market, that will confirm to them that the employment report was an anomaly last week. However, if the retail sales report is weak tomorrow, then I suggest that they're going to say, whoa, wait a minute, maybe it wasn't a freak, maybe it wasn't an anomaly. So, I mean, that was what I pontificated about over the weekend, and I'm not an economist, and I don't usually do things like that, but we do have market understanding, self-understanding, and market logic. And that appeared to me to be the logic of what the market was going through. That is very consistent with the way we have traded this week. It is also consistent with the trade that you see right now. Here it is the day before the retail sales report. You have a market that is in balance, and it's in yesterday's range, and it's a balancing type of market. I believe it's balancing, setting up for the important report tomorrow morning. Now, I'm not a report junkie. I'm trying to show something else here. Just a second. What I want you to notice is, yes, we have an all-time high, pit session high up here. Just above it, we have an all-time high made in the electronic session. The market has been one time framing lower all week. In other words, this high was lower than this high. This high was lower than this high, this high, this high, this high. So we've one time frame lower. Now this is the 5th day following the all-time pit session high. But yet the market's come off very little. This high was at 2010, and the high today is 1993. So that's 17 handles off the all-time high. That's absolutely nothing for a market that has been one time framing lower all week. Basically, this market has come into pretty short-term balance, and I think you ought to get ready for something that's probably going to be more substantial here coming up in a day or two. And tomorrow may be an important day. Okay, again, that's not something I normally talk about. And when the numbers come out tomorrow, I do not look at the number itself. I refuse to do that. Anybody that's heard me before, that The problem, if you look at the number itself, it has a tendency to give you cognitive dissonance. If the number is positive and you're trading on the positive side, you're fine. If the number is positive and the trades to the short side, you get hurt pretty badly. What I like to do is I look at the number and I see what is the market's reaction to that number. And that's the most important thing. So right now, we're fairly well balanced. The market's been down all week from a one time framing standpoint, but it's really only off 17 handles from the all-time high. Absolutely nothing. The market remains in pretty tight balance right here. But I think that I think tomorrow will be important. But what's important today, if you're trading today, as we said, you've stayed within the overnight high and low. As we said earlier, those are important daytime frame references. And let me recap important daytime frame references very quickly. They're going to be unchanged from the previous day. They're going to be the opening. How much does the market, here's the opening today. The market traded down through the opening, no real follow through. And so, we went back higher. Half back, overnight high and low, previous day's high and low. Those are references that are well within the realm of daytime frame traders, day and short-term traders. Mostly when you're within tightness that we have today, it's mostly daytime frame traders. When you start getting outside of yesterday's range, then you probably have the entry of at least short-term traders. Remember, short-term traders, 3 to 5 days, maybe slightly longer. So one of the questions I'm always asking is, who's trading? What am I dealing with today? Because the behavior of each of those groups is somewhat different. For example, day traders, as you know, they come in flat, they go home flat. Short-term traders, they can take positions home overnight. But they're not married to the market. They're still pretty fickle, but they may be in there for a little longer period of time. The intermediate and long-term traders, they're much more serious, and when they come in the market, we normally see far more change occurring and more directional commitment. People are always excited to say, they're too quickly say, well, right here, when we look back on Tuesday, was this the long time frame coming in? And my answer to people that ask me that, probably not. Based upon how fat the market was here, it's very unlikely that they're going to wait till the end of the day to come in. So there's a lot of understanding that goes on with trading. And it's a skill you have to develop over time. And what we're trying to do is help you know what to look for. Anyhow, let me take some additional questions, Julia.
Great, thank you, Jim. Right now we're scratching up toward the overnight high. Could you maybe mark that on your profiles just so people can see it? How would you gauge the auction right now, and do you think it's a likely target?
Well, right now the market's balanced. It's a likely target, of course it is. It's not far away. It's very visible. Trading is very visual, and the shorter the time frame traders, the more visual they are in the market. But basically, you've got the low this morning. You've got mostly short covering in here from the low. We've got too short. You don't have any new money coming in. Is that a target? Yes, it's a target. But who knows what the day is? I think the odds are going to be pretty good that we're going to take out the high and get to the overnight high before the day is out. But it's a very low confidence day, and I have a tendency in these days just to go ho-hum and go do something else or keep myself out of trouble. Okay, other questions? Do we have anything else developing out there?
I beg your pardon, I was on mute. With regard to anomalies, Jim, obviously there are these jutty edges here on yesterday's profile, for example, that were circled on the slide. But can you talk about what they represent in terms of the auction process and, the behavior of people we're competing with? Can you just speak a little more to that?
They just represent an unevenness. It's usually this forcing action is usually, there's two types of forcing actions usually, short covering and long liquidation. A third kind of forcing action might be if there was some catastrophe that took place, some wonderful event or some catastrophe, and the market just emotionally went wild for a short period of time. But more than likely, when you see anomalies, the result of short covering or long liquidation. And for example, if people are short, let's just get me out at any price. They're not very rational. They're so scared. And the same thing, if they get too long, they're too scared, and they're acting in an uneven manner. And when they're acting in it's just a way to visualize the personality of the people trading in the market. When you go up like this, they're short. It's usually a sign that it's very emotional trading. You all know that when you make emotional trades have a tendency not to work out too well. And that's what when you see these anomalies, that's usually an indication of emotional trading. This morning, the anomaly up here, one indication of emotional trading. Got to short. Boy, I don't want to miss this trade. I got to get short. They emotionally got short, just following price rather than anything else. And that's really, it's just a way to measure emotion. When the market is calmer and it's more rational, you tend to get smoother profiles. You tend to get a little more elongation, and you don't have these jagged edges. Okay, other questions?
Thank you, Jim. Great. How do you compare anomalies with the TPO construction versus anomalies within the volume profile? Jim, go ahead, Jim.
Well, I don't use volume profiles, and the reason I've been through this multiple times, the reason I don't use volume profiles is that the three components that I look at are price. Price is an advertising mechanism. Time regulates all advertised opportunity, and volume measures the success or failure of the advertised opportunities. A volume profile does not incorporate time, and time is the component that regulates the market. So when I look at this, I use the normal TPO profile. However, if you will notice, I have total volume to the second column to the left, and I have the current volume for today. This is volume at all prices. Directly left of the profile is the volume that's taking place right now. So I incorporate volume. It's very important to me. But the profile I use is the TPO profile because it incorporates time, price, and volume. The volume profile itself does not do that. It misses one of the important components for me.
Okay, great. Thank you, Jim. And in terms of value today versus yesterday, clearly we're tight and right inside, almost perfectly balanced inside yesterday's value area, which is the lighter blue shading you see on Jim's profiles. Someone's wondering, if we come back down to the overnight low, considering the value being, balanced, is that still a valid area to trade, as a fade trade, as a, say, buying the overnight low?
I have no way to tell you that at this point in time. It's, it depends on when it happens and what is the context leading up to it. For example, let's say that the market starts working lower period after period after period, and it gets wider and wider down there, then more than likely it's not a good place to buy. But let's say all of a sudden right here it popped down there, and and with a very quick period of time, totally different situation. The profile's fat up here, it got thin down here. Just the other day, look, when we're talking about the volatility we had the other day, the market new high in I period, new low in L period, and we settled in here. It was just a wild kind of day. So context is everything. When you look at this day, I got very lucky on this day because it was so fat in here. It was so fat in here. I thought there was a really good chance it gets pulled back to it. So that was the context. So the context at the time that we went up to the high, it may have not been the overnight high, but the time that we went up to the morning high, the context was this was very fat down here. Now, change the context and make this very elongated. That same rally to that high might be totally different for me. Everything, the the market, it's a continuous two-way auction process. The market continually auctions from low to high and high to low. What the profile does, it organizes those continuous auctions, and it allows you to visually see some very complex information under a distribution curve. That's the real edge and the real advantage of the profile. You get an idea where the most trade was taking place. You get an idea what the composite of these continuous two-way auctions looks like. What's the net effect of what is going on? That allows you to get a much better contextual understanding of what is really occurring in the market. It can change at any time, and that's why you follow this idea of the continuous two-way auction process and understand that market. We can go from rotational to trend or from trend to rotational very, very quickly. Okay, other questions?
Yes, on Tuesday night, the overnight inventory was, within Tuesday's pit session range. Do you ever see that as a game? It's just that they're fading the low, and that is there any game in particular you're seeing with the overnight trade when it stays inside the prior day's range?
Well, first of all, there's nothing really going on, and when there's nothing really going on, you will find that very often it will go down to references from the previous day. For example, up, down, up 2. Okay, the settle from yesterday was right here at 1955.25.
95. Yep.
Okay, the low of the high last night was a tick below it. The anomaly, the overnight range, I had the anomaly down, first anomaly down here at 1986, still within yesterday's range. The overnight trade was just slightly below that. It covered all of these. So, yeah, I think that traders do use that. They do use some of the references from the previous day to guide them overnight. But again, overnight, remember, overnight trade is very emotional. It tends to be weaker traders. You'll see it in 3 segments. It'll trade one way when you have Asia. Sometimes it may trade totally different when the markets open in Europe, and it may trade totally different when we open in New York. But it's very fickle. We've calculated, not scientifically accurate, but approximately 65% of the time, the market will correct or have a counter auction relative to overnight inventory. Let me bring that back for a second. Let me show you something in here. My position was a hedged position coming in from overnight. I was a little disappointed in myself because my hedge should have been a little shorter than it was. And, I sucked it in and I said, let me see, overnight inventory was 100% short. We measured from the settle from the previous day, 100% short. Let me see if I don't get a little bit of a break off of the overnight inventory that allows me to get my position back the way I really wanted it. And that's exactly what happened. So the overnight inventory gave me an early rally, and that early rally allowed me to adjust the position the way I wanted to adjust it. So, I use overnight inventory to my advantage. Now, if we'd have taken this out and gone straight down below, well, it's not what I wanted to see. But there's a lot of uses to this. You can use it to adjust positions. You can use it to go long against it. You can use it at the high and low as references. But it's like any other reference. But when you see it's all contained within yesterday's range, and you see like last night, 100% of it was short. We know that normally overnight inventory is the result of weaker trading money, and that's what allows you to kind of fade it a lot. Like I say, about 60% or 5% of the time is what we have found. And that doesn't mean it has to go all the way back up and take it out, but it supports the market early this morning and lead to a small rally. So as long as you know that coming into the market, you know, you're not too anxious to go short. When you see the market down, the tendency from people to get impulsive, oh, this market's going lower. Boy, this thing's been low all night. I'm going to short this market. Boy, I'm going with this. And all of a sudden, the market rallies. But if you understand that going with the break this morning was a very high-risk trade because the market was 100% short from overnight. I mean, you're really defying the odds. And that's why it's important to know that. If you didn't know overnight inventory and the importance of it, it would have been very easy to emotionally think that you wanted to be short this morning. Instead of, a better position was to fade the overnight inventory. The worst position was to go with it. Now, if there's sometimes gaps are a different animal. If a market is going, if it gaps higher or lower, for example, if the market gaps higher, well, then you've got a pretty good idea that the overnight inventory is long. You needed that in order to gap higher. So we have different rules for gaps. And that is, a lot of times, the bigger the gap, the lower the odds that the gap was refilled, and the greater the odds that you're going to get upside continuation. And the reason for it is when you get a larger gap up or down, there's so much dislocation from people's positions. So if they were caught short and we gap higher, so many times they're just scrambling to cover their shorts, and smarter traders know that, and they bid along with them. Okay, a couple of more questions here.
Yes. Jim pays strong attention to the overnight market inventory. Although he focuses on the S&Ps, would he share some insight about whether he's observed this inventory adjustment in other contracts such as energy, fixed income, ags, and currencies?
The answer is yes. But the best answer is understanding this. Any market that you're going to trade, make your own observations. Make your own observations. It's something to look at. You make your own observation and you make your own decisions. If you don't do this, then you won't have the confidence to act on it, and you won't understand the contextual differences. For example, you know, let's say gold's got a 6-month, you're at a 6-month low, you know, and that low, you break through that low sometimes overnight, and that's it. It's to the downside. It is a go, no-go situation. But sometimes you break through that, and it triggers so many stops. It triggers so many stops that even though the inventory was short, or you may have been short overnight, and you take out that low in the morning, you know, the stops may be enough to really send the market downward. So you always have to view everything in context. There's no simple answers to anything, and I'm sorry, that's very frustrating to people. But understand that the success ratio is very low. You're competing against people that have traded for many years and have survived a lot of battles. They understand the markets. If you're going to compete against those people, you have to have the same mindset that they do. Sometimes you'll fade them, but you have to understand what they're doing. You have to be able to get inside their head, and that's really what we're trying to do. But again, so much is context. But I come back, and when we do the intensives, what we're trying to do is talk about these principles over and over and over again, so that you see multiple kinds of types of markets under different circumstances over an extended period of time. You have a much better chance than just going and being in a classroom for 3 to 5 days at a hotel or something. Even if all the information was perfect, you had great markets, it takes a long time to assimilate all of that information in there. Okay, the question earlier was, you know, do I think we get to the overnight high? And I said, I think there's probably a pretty good chance of it up here. I don't know if we're going to, but we have a poor high today. We have a poor high from yesterday, poor high for the previous 3 days. very, very unusual. We now have 5 out of 6 of the last days have poor highs, counting today. Very unusual situation. My guess is we get a little more short covering sometime before the day is over. Okay, a couple more questions, Julia.
Yes, thank you, Jim. Are you watching point of control migration in this auction? When we print in the next 5 minutes, when we start a new print, we'll print a wider point of control. It'll migrate higher. Are you watching this?
No, what I'm really watching right now, because it's such a quiet day, I'm really watching this one time framing. If you see from the low today, D period did not take out the C period low. E period did not take out the D period low. F period only took out the E period low by a single tick. That doesn't count. It needs to take it out by 2 ticks. So this market is one time framing higher from the low. So really what my focus is on right now is the one time framing. In other words, I've started a new profile with C period. Anytime there is a significant high or low, I suggest starting a new profile. So right now my focus is on the one time framing. If I, and okay, there I went above that, so I'm still one time framing higher. That's where my focus is more than anything else. Now, because this is such an unusual day, if there's anything on the upside this afternoon, I think the odds are pretty good that we have a double distribution day. In other words, we break through here, we take this high, and we don't look back. If we come back up here, as we're going to change periods in 3 minutes, we come back up and we fill this in, then you've got a much lower, then the odds are much lower that you get much more on the upside. To get much more on the upside, I think the odds are anything can happen, but I think you need to have a second distribution that stays above this early distribution. The other alternative is continue to watch the one time framing. And you don't want to fade one time framing markets. Also, you remember you had a poor high from yesterday, you had a good high the day before, but yesterday's high is also a potential target this afternoon. What will be up there? There'll be stops above the overnight high, there'll be stops above yesterday's high, and that's what the markets would really like to go and get those right now. I don't know if they're going to make it, but that's what they'd like to try and do. Okay, let me go back to the slides for just a moment. Let me give us my commercial. We talked about the intensive. September 29th, October 31st. That's 5 weeks. Includes about 8 hours per week of live narration and instructions of the S&Ps. We will, from time to time, look at some other markets such as crude, the dollar index, and gold bonds, because particularly the dollar index has been having an effect on the S&Ps lately. I think we've always done more than the 8 hours. We've always added a couple of sessions if it was very important. Also, as I mentioned earlier, includes intraday chat dialogue at our site where I'll provide one-way commentary when we're not online. So it's like we're as close to you as we can be for that entire period. The last intensive we did, I was there every day. Earlier intensives, I was in and out depending if there's anything going on in the market. But last time I decided to stay with it all day, every day, and I will do the same here unless I'm at a doctor's appointment or something like that. Upon enrollment, you start receiving the daily reports. That's the recap and preparation report, as well as the pre-opening report in the morning. And upon enrollment, you get full access to our member archive, which over 100 trading articles and 50 webinars. Good preparation. We haven't announced the dates yet, but the last intensive, we had a lot of people that were either new or relatively new to the market profile. So Julie and I will do a couple of separate basic educational webinars in order to bring people up to a little better speed prior to the start of the intensive on September 29th. Julia, do you have any comments before I take one or two final questions?
No. They'll start receiving the reports immediately, but we will have a couple of sessions for the newer traders to ramp them up, so you be as prepared as you can be. And it'd be great to have you if you want to learn more and you want to be immersed in the market for a month and, take on some new information and see the market in an entirely new way, in a different way than you're probably accustomed to seeing it. We'd love to have you. And you're welcome to call us or email us if you want to have a conversation about it. Jim, before we leave, the question about the gap rules, I don't know if you can pull back to a gap we had recently, but the question is, if the gap rule is quite simple. If the gap is filled and we don't get at least unchanged or similar value to the day prior, to the gap day, the odds of a later day move in the direction of the gap are higher. And Eric's asking, if we fill the gap, he's asking, is that really the case? That do we need to fill the gap to have the gap rule come into play?
Well, no, part of the gap rule, if the gap isn't filled, then you go with the gap.
Yes, but if it's filled and it starts to become, value is not unchanged, in other words, value is not similar, but remains a little higher, you would say that the value, that the gap, we are likely to see a move in the direction of the gap.
Yes, because really, what we're really talking about is trading value. We trade value, not price. So if you think about the gap rule, if the gap is filled, but value isn't overlapping to the previous day, then value is going to be at a minimum overlapping to higher. We trade with value. So if the value is overlapping to higher, then the odds favor that we get, some little strength as the day goes on in that profile.
And if the value does become unchanged, you would say, no, that deal is off. If the value becomes similar to unchanged,
that is correct. And that's, if you fill the gap and value becomes overlapping, that's a pretty weak sign that there was some consistent selling in there. But again, none of this stuff is science. People like to have the rules be exact. Unfortunately, they're not. All we're trying to do is get some common sense ways to observe and understand what is really going on underneath the market.
Jim, today, in terms of upside continuation, we know we still have 4 poor highs. We had 5 poor highs, which is
We still have 5 because today is a poor high again.
Well, today now we just printed a poor high again, so this is an incredibly unusual situation. But
I've never seen it.
Yeah. Someone's asking, do you think that because the market repaired these anomalies from yesterday that you showed in the slide at the beginning of the presentation, do you think that the accumulated poor highs along with this were likely to go for the all-time high now? Is that the destination of trade?
Well, I think that's certainly a potential. I mean, this has been an extremely unusual market. Remember, it still has been a market that has been controlled or manipulated by the Federal Reserve. We've never been in this situation before, and there's a lot of uncertainty out there right now. But I would say from an odds standpoint, the odds favor that we take these highs and look above them. Does it have to happen? No. But you take it one step at a time, and you stay with value. I put all the profiles together to show you that, even take today's high, 1995, that puts you only 12 handles away from the all-time high, from the all-time pit session high, or 13 handles away. So there's really been no give back. There's really been no give back in this market so far. Yeah, you've had some liquidation, but you haven't had any indication of any serious selling coming into this market. That doesn't mean there won't be. And it doesn't mean that there's not a lot of people very nervous. Remember, this idea of drip, 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 drip. But for right now, there has been no indication of any meaningful selling by intermediate or longer term time frames. The odds still favor going back to the all-time highs. Now, remember, odds are just that. The odds can be 10 to 1, but remember, 1 out of 10 times you're going to lose. Okay? Final question.
When you have a one-tick failure above, like for instance the F period here, she's looking for a little direction how to trade it. So we have a narrow bar in E period, and we look one tick below, or we look one tick below, you know, the overnight session or the prior pit session. How do you handle that type of trade? She's asking, is it an asymmetric opportunity? And you know,
if you're talking about the F period right here below one time framing higher, this is usually a very wonderful day time frame opportunity. Happens all the time. It's usually an indication it's shorter term money or shorts that are buying it. It's not usually not longer term money, doesn't wait till you get exactly there. But shorter term money will do that. And once you can't take this out, you're still one time framing, just go with the trade. All right.
And the destination would be the other side of the range. So
yeah.
If we did it the other day, you know, looking below a prior pit session low, comes back into range. You know, the destination, we don't know if it's going to get there, would be the other side of the range. Now, in this one, it went to the other side of E, and obviously it was a poor E period. Yeah, it was a poor high, and it blew it out. They know there's stops up there, people who shorted and or buy stops to get in.
They didn't get the stops from yesterday. Yet.
No, there's
confidence remains very low. Anyhow, let me say thank you very much, and we really look forward to a lot of you joining us for our intensive starting at the end of this month. Once
Jim,
again, yeah.
Thank you. Ahead. Could we look at crude real quick on CQG? Would that be okay before we go? We have a question that the point of control is several ticks above unchanged, so there's a lot of conflicting information for him to reconcile. At the moment, he's staying out of crude, but he's curious.
What you have in crude, you have a short covering rally. The market opened. The market got ahead of itself.
Gap lower.
Opened lower. Hold on. Let me... Okay, so you had a downside breakout, you had a gap lower, downside breakout in crude this morning. Let's go back to the profile. And they filled the gap. They filled the gap, and you got short covering. You got a short covering going on. Once it looked below yesterday's range and came back in, the destination trade is to the opposite extreme. Mm-hmm. The opposite extreme is right here. The single prints are here. Guess what? It went exactly to the base of the single prints. So what you had is a short covering rally. You had a short covering rally, probably not new money coming in. The P formation is usually an indication of short covering. Value is overlapping to higher. You'll have a we'll be focusing on now is probably a 2-day. If I were looking at this now, I'd look at a 2-day balance. But right now, it's balanced right in here.
Okay.
Okay.
All right. Great.
Now,
Thank you, Jim.
Crude is wild. I mean, every market you trade has a little different characteristics. It would be nothing unlike crude to break all the way down in the last half hour and then all the way back up. You know, crude is a very thin market, and when you start to learn crude, you will find some wild things can go on in the last period. Let me, here's an example. This isn't a big one, but, you come down early and then you rally late going into the close. Hasn't been as wild as it is sometimes. But this is a day you've got short covering. I do not see any indication of new money coming in the market. I see short covering. So you got to be, you can either go higher, but you could get a liquidation break from here simply because it's gone and it's gotten very fat. So you've got the short covering. Remember, short covering can weaken a market as it takes potential buying power away from it. Okay, once again, thank you all very much, and we hope to see a lot of you at the next intensive. Thanks, Julia.
All right, great. Thank you, Jim. Thank you very much, and thank you, everyone. We'll get this recording uploaded into our site, And everyone have a wonderful afternoon or evening wherever you are, and our next webinar is next week, so check it out at our website under upcoming webinars. Okay, thank you very much, everyone. Bye-bye.